Something strange is happening to the Australian property market. Prices are rising fast. In some areas, by thousands of dollars a week. Rents are lagging behind. And for someone trying to build passive income through property, this presents a problem, because when prices rise but rents don't follow, the old way of investing in property no longer works anymore. Now, I've been investing in property for 23 years, and over the last 9 years, I've helped over 500 investors buy investment properties in multiple areas around the country. In fact, in 2022, I was voted one of the most trustable real estate entrepreneurs in the entire Asia Pacific. So in this episode, I'm going to show you my two-step process to build passive income through property, and how one of our clients used this strategy to go from one property to 5 very, very quickly. When property prices are rising, people get fixated on securing a high rental yield from day one. But the reality is, higher property prices mean lower rental yields, at least initially, because, like I said, rents don't rise as fast as property prices do. Let's look at our client, Ruth, and her partner. Now, when they bought their first investment property, they deliberately chose an area with strong capital growth potential and a solid rental yield of about 4%. Now, what that meant was, on their $700,000 purchase, their annual rental income was roughly $28,000 per year, or about $540 a week. Now, initially, this wasn't enough to cover their mortgage and their holding costs, meaning their investment was negatively geared in the short term. But here's why that was actually a smart move. You see, by buying in the right area and accepting this lower rental yield initially, they position themselves to benefit from significant growth in both the property value and future rents. Over time, rents in the area gradually caught up, and their yield, based on the original purchase price, improved substantially. So be prepared to handle some negative cash flow initially if you're serious about building wealth through property. Now, I'm not talking about sacrificing your lifestyle here, right? Ensure that the negative cash flow that the property might give you initially suits your personal cash flow and your personal situation. Then choose properties in location that have strong potential for both capital growth and rental growth, even if that means accepting slightly lower rental yields to begin with. Because when you take this approach, you'll get both capital growth and rental growth. That's how you ensure each property is a stepping stone to the next property, so that you can build true wealth that lasts. You see, the two biggest mistakes I see people make when they don't understand this is they either focus on buying properties with really high yields in smaller country towns, like mining towns, for example. Now, the problem with these areas is they don't have the strong economic diversity. They don't have enough demand from owner-occupiers, people who are actually buying to move to this area to actually live. So then what happens? Well, if it's a mining town and the mining industry goes through a downturn, the jobs disappear. Now, if there wasn't much owner-occupier demand in this area, what that means is most people living in this area are likely to be tenants who are there for work. Once the work disappears, what's going to happen? They're all going to leave. And now you are going to be in a position where you're going to struggle to get your property rented. And that positive cash flow that you thought you were getting because of the high yield, it could evaporate overnight. But it gets worse than that, because most people who bought in this area are going to be investors. That's what it means when there's lower owner occupancy demand. It means that most buyers are investors, and many investors are going to try to sell to get out when they don't get that consistent cash flow that they were used to getting. Now, what happens if you have lots and lots of people trying to sell property, but not enough buyers? Prices fall. It ends up being a race to the bottom, and you end up in this horrible situation where you have a property that you're going to struggle to get rented, and worse, a property that could easily be worth less than you paid for it. If you think this couldn't happen, we have seen this happen countless times before. Over my 23-year investing career, I've seen so many people come unstuck because they took this risk. You need to ask yourself, Is that risk worth it for you? But why do people even make this mistake in the first place? It's because they assume that passive income is built solely by collecting rent and focusing on rental yields. But real wealth in property investing comes from equity growth and rental growth, because equity is the tool you leverage to purchase additional properties, and rental growth gives you the cash flow to sustain your portfolio over time. That's how people end up buying multiple properties over a few years. Now, let's go back to Ruth and her partner. Now, once their first property grew from $700,000 to around $1 million, their yield based on the original purchase price increased significantly, going from the initial 4% to around 5.3%, as rents rose eventually to about $720 per week. They're still rising today. So that meant that not only was their property comfortably covering its costs, it was washing its face, as some people say, but they'd also created substantial equity. So what did they do? They didn't sit idly. They made the smart move. They used the equity strategically, took it out and bought another investment property. They then repeated this process multiple times, eventually building up a portfolio of 5 investment properties. And using this strategy, each property served as a stepping stone to the next, creating not just income, but genuinely long-term wealth. In fact, now their portfolio is positively cash flowed, they're thinking about buying property number 6. But here's the interesting part. Ruth never intended on buying multiple properties. She never thought she could. Her plan was to buy maybe one property, and then maybe if things went well, she might have bought a second property down the track. At least that's what she was thinking. She revealed to me recently that she never thought it was possible for her and her partner to have 5 properties so quickly and potentially be considering a 6th. And I hear this feedback from clients so often who we've helped follow this strategy. They're amazed at how quickly they're able to build more wealth through property faster than they ever expected. But there's actually a second mistake I'm now seeing more people make, because people are finally starting to realize that they probably shouldn't be buying in these small country towns, because the high yield actually comes with a lot of risks, like I just mentioned, but they still want to play it safe. So what do? They focus on price. They focus on trying to buy cheaper properties, say well below what their borrowing capacity is, because they don't want to overstretch themselves. They want to minimize the risk. At least that's what they think. But here's what they get wrong. They assume that the rental yield on a lower priced property is always going to be more than a property at a higher price. This isn't always the case. For example, last month we helped 2 clients buy properties. The first client, we helped them buy a property for $930,000 because that's what their borrowing capacity allowed. The other was for $1,050,000 because they had a bigger borrowing capacity. But here's what might surprise you. The rental yield on the more expensive property was actually better than the cheaper property. The cheaper property was being rented out for $760 per week, which is still a solid 4.2% rental return. But the more expensive property actually got rented out at $930 per week, which meant it got a 4.6% rental yield, almost 10% higher. That meant that the cash flow on the more expensive property was actually better than the cheaper one. Now, both these properties met the criteria I've been talking about today, which means they are in areas with strong rental growth and capital growth potential. So both these properties will be stepping stones to future properties for these clients. However, what I want you to take away from this is don't assume you should just focus on cheaper properties because they're going to be better for you from a cash flow perspective. That's not always the case. Instead, focus on buying the best quality property you can afford from a cash flow perspective, and treat every property as a stepping stone to future properties. Invest in areas and properties that demonstrate both rental growth potential and capital growth potential. You need both. One without the other is like trying to drive a car that's missing a wheel. You're not going to go very far. And regularly review your portfolio. Use the equity you've built to buy additional properties when your cash flow allows. And if you follow this cycle, that's how you'll end up creating long-term wealth through property that lasts. Now, if you're thinking this all makes sense, but you want help with that, then let's talk. Booking a call using the link in the description below to have a totally free, no obligation consult with a member of our team. And let's find out more about your goals, what you're looking to achieve through property, and if what we do can help. But the next question is, once you understand this strategy, where do you put your money? Well, if that's what you're wondering, check out this next video where I talk about where I would invest if I had $100,000 in savings or equity. I talk about how I split the budget, where I invest, and why. So go and check out that video now.